So today's class is about financial planning basics. Our overview is going to be just some general financial planning concerns. Uh, but just remember, there's no one size fits all for financial planning. You really want to have a personal financial plan that's going to relate to you and relate to your goals and your objectives. So let's go ahead and kind of walk through some of the various basics that we're going to talk about. So we're going to talk about setting goals. We're going to talk about budgeting, how that helps you relevant to financial planning. We're going to talk about the importance of an emergency fund and why someone would have that. We're going to talk about insurance, basically the protection planning of your entire financial plan to make sure things don't go awry when something may happen unexpectedly. We're going to talk about using credit, the importance of credit and how to use credit. We'll talk about investing, some investing basics. And we'll talk about tax planning, which is becoming more and more important to make sure that you're minimizing your taxes and maximizing your outcomes for your goals. We'll talk about some of the various goals that you may have, such as saving for college. We'll talk about retirement planning, and we'll also talk about estate planning. So trying to leave nothing out of the comprehensive financial planning picture so that you have a good background as far as what financial planning might mean for you and for your goals, things that you might be looking at in the future. So setting goals is an important part of financial planning. It's really the first step that you want to take. So really defining what your goals are for the future, really putting things down so that you know what you want to accomplish. Because without that, it's pretty hard to try to work toward the various goals that you might have. So some of those goals might be short term, such as paying down credit cards, saving for a down payment for a car. And then other goals that you might have might be a little bit more longer term, such as, saving for a house, saving for a child or a grandchild's education, or even planning for your own retirement. So we'll take a look at some of these various aspects, and we'll talk about setting goals a little bit more, and as well as, how do we take a look at your goals relevant to that. So we use an acronym, and it's called SMART. So how smart are your goals? And SMART stands for, are they specific? Are they measurable? Are they attainable? Are they relevant? And are they timely? Okay. So when we talk about each one of those as far as being specific, you want your goal to be clearly defined, relevant to that. So, I want to save for my child's education is really not a specific goal versus I want to save for the cost of a 4-year education at, let's say, Penn State University. And I want to have that saved by the time my daughter reaches the age of 17, then that's pretty specific. Okay. And then, is my goal measurable? So can I track the progress? Am I clearly knowing when am I going to reach it? So, again, a goal that says I want to retire early isn't really measurable, but a goal that would say that I want to retire by the age of, let's say, 60, that's pretty measurable. I know how much time I have between now and age 60, and then I'm also going to need to know how much I'm going to need to save based upon that that long-term goal of retirement. And then, is the goal attainable? So something that's actually going to be reachable. So saying that I want to save $1 million in 5 years, for most people, that's really not attainable. But for someone saying that I want to save $1 million within 30 years, yeah, that can be pretty attainable, and that's pretty reachable. And then, are your goals relevant? So do they make sense to you, not necessarily to everyone or to maybe someone else, but do they make a lot of sense to you? Because if they do, then you're going to be more willing to work toward that goal and really want to achieve it. And then lastly, are the goals timely? So is there a time frame or a deadline for reaching the goal? Such as, again, I want to pay off my credit card within 12 months. So that's pretty timely. I know that I have 12 months to try to achieve that goal. I could calculate or figure out how am I going to do that in the most efficient manner possible. So you want your goals to be smart, so that, again, you have some groundwork or some basis toward working toward those. Another key point in goals is trying to write those down and prioritize them, because the more your goals are written down, the more likely it is that you're going to want to achieve those, and you're going to look at those periodically, and you're going to work toward those because they're going to be measurable, for one. So you're going to see if you are on track toward reaching those goals. So let's talk about budgeting. So budgeting isn't necessarily putting people on a strict budget. It's really more so talking about, what is my income? How do I get that income? Is it from working? Is it from having rental properties? Do I have government benefits because I might be retired already? Am I earning interest on some of my investments? Or do I have interest just from a regular bank account? So I take all of my income and then I subtract my expenses. So we typically have lots of expenses, and those expenses can vary from one month to another month, but you want to be able to try to track those expenses over a certain period of time so that you're making sure you're capturing most of the expenses that you have. And then there are also fixed expenses. So fixed expenses are things like your rent, your mortgage payment, things like your utilities, food, gasoline. So things that are, pretty steady, things that are going to come around each and every week or each and every month. Discretionary expenses, we tend to call that the fun money. So this is money that you'll spend on things like travel, recreation, entertainment, charitable contributions. Some of those may be classified as discretionary. So what we do is we take a look at all of your income versus all of your expenses, and hopefully we come up with a surplus. So a surplus would mean that you're in the black, meaning that you have more income than you have expenses, versus being in the red would mean that you'd have more expenses than income. So you're spending more than what you're bringing in, which typically would mean that your credit cards would normally be increasing. So hopefully you're running a surplus. And then one of the first things you might want to do with that surplus is to create what we would call an emergency fund. So an emergency fund is basically a fund that you would set aside for emergencies, for opportunities, just making sure that if those things do occur, it's going to help you not get off track because you have to dig into your other investments that you might be using toward reaching your goals, such as retirement or the down payment for your home, various aspects like that. The other important factor is knowing, where you might keep that money. And typically an emergency fund is going to generally be based upon your expenses. And typically a rule of thumb might be that you might want to have, or you might want to keep anywhere between 3 to 6 months worth of your expenses in that emergency fund. So keeping your emergency fund uh, not necessarily just in very safe places, like a checking account, may not really be the best alternative. Um, because if we think about, let's say, maybe 6 months of your income, you're probably not going to need to write a check at one time for 6 months of your expenses, right? So normally you might want to consider various types of investments where you might be getting a little bit of interest on, let's say, maybe 50% or 40% of your emergency fund. And you can see today, even some conservative type investments, such as money markets or certificates of deposit in a bank, those are actually paying some interest today, whereas in the past, you probably weren't getting much interest on those. So we'll talk about risk management with insurance. So insurance is really just a form of or a source of sharing those risks with other people. And you're transferring that risk that you have to an insurance company to help you mitigate the large impact of what a risk might do to your overall financial situation, how it might impact your family and yourself as well. So some of the common types of risks that we look at are things like health insurance. So if you were to become sick or injured, you'd want to make sure that you have adequate health insurance to cover those costs because those costs can be very expensive. We look and review things like auto insurance just to make sure you have current coverages as well as adequate coverages. Because again, replacing an automobile is very expensive, and even fixing minor repairs can become very expensive as well. Things like life insurance. So life insurance can be either used to create an estate or to protect an estate. So by creating an estate, you would be using that to provide survivorship income. So if you were no longer here, how would your survivors go on because of the loss of your income? And then as far as protecting an estate, it's used to protect an estate from the erosion that could be caused from taxes upon your death. So property insurance, it's used to cover large items such as your home, personal property. So you don't want to have your home not being insured. And for most people, if you have a mortgage on that home, they're going to require you to have property insurance because they want that asset covered. Because if there is a loss, they want to make sure that they're going to continue to receive their payments for that mortgage. So liability insurance, that's typically used for large expenses that may be occurred because the defense of a potential devastating claim against you. So let's say hypothetically you were in an automobile accident and you injured somebody pretty severely. They could come back and sue you quite substantially. So you want to make sure that your liability insurance is meeting your needs. And typically you'd want to have it be equal to or greater than your net worth. So disability insurance, that covers you in the event that you were to become disabled, you're no longer able to work, or even maybe you're no longer able to work even for a short period of time. How would your family survive, or how would you manage your expenses without your income? So having disability insurance, we tend to look at that as covering really one of your largest assets that you have, your asset as far as your ability to work and your ability to earn income. And then lastly, we talk about long-term care insurance, making sure that you're covered in the event that you were to need long-term care assistance, such as in a nursing home, or even assistance living in your own home. So covering against those specific risks, knowing that those expenses can be very exorbitant and could wipe out your entire savings in a very short period of time. So we'll talk about using credit. So using credit in a responsible manner, not using credit irresponsible. So, one of the definitions of credit is it's the provision of money, goods, or services with the expectation of future payment. So people that are lending you money, their expectation is that you are going to pay them back. So when these creditors lend you money, they typically look at what we call the 3 C's of credit. The first C is capacity. So capacity is measured by your ability to pay back that loan. So it's based upon your income, it's based upon your expenses. So do you have enough income to generate the money to make the monthly payments to pay that debt back? So character. Character is based upon your track record as far as your repayment of previous debt that you may have incurred. So do I have a track record of being a good payer or missing payments? That's going to go into figuring out various aspects as how am I going to get that loan. The third C of credit is collateral. So collateral is the property that would be used to secure the debt that you're borrowing against. So a good example of collateral would be a home. So I took out a mortgage to purchase a new home, and the collateral for that mortgage is the home. So if I'm no longer able to, or if I'm no longer willing to continue to keep making those payments on that mortgage, the mortgage company has the right to come back and take that property and dispose of it to then in turn try to recoup as much of the balance on that mortgage as possible. So how creditors determine your credit worthiness. So they'll take a look and they'll make you fill out an application, providing them with a lot of financial information based upon yourself, based upon your habits, your income, your resources. They'll pull up a credit report, which comes from the various credit companies, which again is going to tell them about your payment history. And then they're also going to look at what's called a credit score. So a credit score really just comes from statistical information that's put together by the various credit reporting agencies. And again, it's basically comparing you to thousands of other similar people relevant to their payment history, relevant to the amount of credit that they may have outstanding, and what are those risk levels. Okay, so your credit score could go anywhere from 300, being very poor, all the way up to 850, which would be considered excellent. So typically, you want to be somewhere above 700 to get you a very good interest rate relevant to that. Because remember, your credit score will determine what type of interest rates that you might ultimately have to end up paying for the debt that you might be incurring. So again, kind of looking at debt and kind of the uses of debt. So we want to make sure that we're using debt responsibly. We're not just using debt to pay our day-to-day expenses. But if we are using things like a credit card, we want to make sure that we're paying that off on a monthly basis so that we again are avoiding large interest rates from credit cards, and we're keeping our credit score and our credit reporting very healthy in that nature. Okay. So there's different types of debt. There's what's called secured debt and unsecured debt. So secured debt we touched on a little bit, which would be things like a mortgage on your home. That mortgage is secured by the collateral. So any debt that might be secured by collateral would be called secured debt. And then there's also unsecured debt. So unsecured debt would be debt that would not have any collateral tied to it. So things like credit cards, things like student loans. So there's really no collateral tied to a student loan. They can't come back and take your degree from you. That's why, those things are unsecured. So some important considerations you'll want to keep in mind when looking at that, really three key factors. One is the amount that I'm going to borrow. The second one being the term. So the term would be what are the requirements, or how long do I have to pay back that loan? Is it a short-term loan, let's just say for 5 years or 10 years, or is it a longer-term loan for a mortgage, which might be 30 years? And then lastly, what is the rate of interest that I'm going to pay on this debt? So if I know all three of these variables, the amount of the loan, the term, the time frame to pay it back, and the interest rate, I can calculate what is my monthly payment going to be for that loan. So you want to know that prior to actually taking the loan on, so you'll know exactly how much you're going to have to pay, and you want to be certain that you feel comfortable with paying those debts down. Okay, so let's move on and we'll talk a little bit about investing and how that can help you reach your goals and objectives. So for some people look at investing as gambling or speculating, things that might be very risky. Other people might look at investing as savings, like a methodical, long-term savings to build or accumulate wealth for the future. So we tend to look at it basically maybe a combination of the two, but you're basically carefully planning and preparing an approach to managing money with the goal of accumulating funds that you're going to need to help you reach those goals that you have. So when you're looking at investing, you want to understand the risk and reward trade-off. So what I mean by that is typically the greater the level of risk, typically the greater amount of return that you're going to see, as well as the lower amount of risk, the lower amount of return that you would see as well. So understanding that is important. Your personal tolerance for risk. So some people can sleep well at night knowing that the stock market might be going up 500 points one day or down 500 points another day. And other people may not be able to sleep too well at night because they worry about that, seeing those fluctuations on a day in and day out basis. So you want to be able to really know what your risk is, and can you control those emotions that may overcome you and cause you to do irrational things with your investments. So the ability of an investment plan to deal with these potential losses. How is your plan set up? One of the best ways to mitigate losses is by knowing what your time frame is for the investment. Typically, the longer the time frame that you have, the more risk that you could take with your investments, because you know that over time, typically the markets, the stock market, various investments will go up over long periods of time versus, if I do need the money in a short period of time, I may not want to take that much risk, knowing that I might need this money in 3 months or 6 months or even 12 months. So knowing what your risk tolerance is very important to help you manage your expectations and help you to manage your overall behavior relevant to your investing. Because the one thing we don't want to see you do is become very uncertain and become very afraid and take money out of the market at the wrong times during your investing career. So other factors in looking at investments, we look at things like growth, income, and stability. So typically investments can be classified as, are they growth? Are they going to increase in value? Typically, again, over long periods of time. They may have more risk associated with those. Or are these investments going to be for income? Are they going to pay interest? Or are they going to pay dividends? Something that I might want to use in retirement. So basically having a plan going forward that if I'm going to retire in a short period of time, I might want to set up my investments in an income phase versus a growth phase. And then lastly, stability. That's the protection of your original investment. So again, you want to make sure that if my goal for that investment is to not lose money, I want to make sure it's going to be stable so that in 3 months or 6 months from now, when I need that money, I know that it's going to be there and it maybe it wouldn't have lost 10 or 20% in the stock market over a short period of time. So anytime your focus shifts from one area to another, you're going to be moving away from the other two. So for example, if my goal is long term, let's say I'm not going to retire for the next 20 years or 25 years, I'm going to focus primarily on growth. So my investments are not going to be they're not going to have an emphasis on stability, and they're typically not going to have an emphasis on income. Okay? So knowing where you're at, knowing what your goals are is important to help you determine, which one of these objectives am I looking for? Is it growth, income, or is it stability? So let's move forward, and we're going to talk a little bit about tax planning. So typically when we talk about tax planning, we're talking about income tax considerations. Primarily, we'll talk about things like federal income taxes during this session. So we'll first talk about things that your employer might provide, things that are called pre-tax dollars. So pre-tax dollars are deductions that are made from your paycheck before any taxes are paid or calculated from those funds. This can help you to reduce your taxes because let's say I have $100 a month withheld from my paycheck for a parking pass that I can pay for with that. So that $100, if I'm in a 22% tax bracket, then that $100 that I've withheld, I've actually saved the $22 in taxes. So it's really only going to cost me $78 in after-tax dollars. So again, it can result in lower out-of-pocket costs because of that tax savings. So other factors or other examples of pre-tax dollars might be things like health or dependent care. So if I have a flexible savings account at work, or if I have a health savings account at work, I can put money into those plans pre-tax. And when I take it out, and if I use it for those qualified expenses, that money is tax-free. Okay? And even things like the transportation costs that we talked about. So some commuting expenses, such as those parking passes or a bus pass, various aspects like that, can help you save money out of pocket. So other pre-tax items might be things like your retirement plan that you have through work. So if I have a traditional 401k plan and I'm putting money into my traditional 401k, it's typically going in there on a pre-tax basis. So let's talk about tax deferral, kind of the other side of the pre-tax. So tax deferral is where there's no taxes that are paid or due on these funds until a withdrawal is taken from the account. So I can put money into an account, I can let it grow tax deferred. I don't have to worry about taking or paying taxes along the way as it's growing, as it's earning interest or dividends, or even any capital gains because it's tax deferred. And in certain cases, if you have what are called qualified distributions, even the distributions may be able to be tax-free, which is even more important, right? So I'm saving on a tax-deferred basis, my money's growing, and when I take it out, it can even be tax-free. But again, you want to make sure that they're classified as what are called qualified distributions. So some examples of that might be a 529 college savings plan or prepaid tuition plans. So a 529 plan allows you to put money into the plan. The money goes in after tax typically. It grows tax deferred. And if it's used for those qualified educational expenses, then the money will come out tax free. So retirement plans, things like traditional IRAs or traditional 401ks. So traditional IRAs or traditional 401ks, the money goes in pre-tax and it grows tax deferred. So along the way, so over the next 20 or 30 years as you're saving for retirement, you're not going to pay any taxes on the growth. But when you do take it out at retirement, you'll have to pay tax on what you put in because that was pre-tax, as well as you'll have to pay tax on the earnings because those were growing tax deferred. And then there's the other side of that for retirement plans are called Roth IRAs. So Roth IRAs or Roth 401ks, the money goes in after tax. The money grows tax deferred. So there's no taxes on the growth as it's growing. And then once you go to take the money out, if you have qualified, if the distributions are qualified, which means in other words you've satisfied certain IRS guidelines, then those distributions from a Roth 401k or a Roth IRA would be tax-free as well. So very important to understand these various aspects, and we'll go through an example of that in a moment. But you want to be aware also that this tax-deferred growth also comes with penalties. So the IRS applies penalties or kind of a slap on the wrist if you decide to take what are called early withdrawals or non-qualified distributions. So typically those penalties are generally 10% of what you're taking out. And don't forget, on top of the penalty, you'd also have to pay the income tax on those withdrawals as well. So something that you definitely want to make sure that if you're putting something in a tax deferred account, you want to make sure that you hopefully don't have to touch that prior to prior to being able to take it out without a penalty. So let's look at our little example here. We're going to look at two accounts where someone had $10,000 to invest in each account. So they put $10,000 into an account that was growing after tax, and they also put $10,000 in a taxable account where they were going to pay the taxes out of the account each and every year based upon the growth. So we're going to assume that the growth of both of these accounts were growing at a rate of 6% per year. The tax rate that this person was in was 24%. So therefore, after a 30-year period, the 6% growth on the taxable account, the balance would be equal to a little over $38,000. And then on the tax deferred account, however, the balance on that account would be a little over $57,000. And the reason for that is we're not paying any taxes on that growth each and every year. So it's allowed to stay in the account. It's allowed to continue to compound and continue to grow as the account matures. And as you can see, even if you did that, and after the 30 years, if you were still in a 24% tax bracket and you withdrew all of the $57,000, you would still have a net amount after taxes of a little over $43,000. So you can see the power of tax deferral and how that can benefit you in the long term. So again, if you have the ability to use tax deferred accounts, it's really in your best interest to potentially do that, because again, you're keeping those taxes or you're keeping that income off of your tax return as long as possible. So let's talk about these college savings plans. So again, a 529 plan is typically used for college education savings. There's typically two types of those plans. One plan is called a college savings plan, and the other one is called a prepaid tuition plan. So the college savings plans are typically individual accounts. There's an owner, which might be a parent or a grandparent, and then there's a beneficiary, which is typically the child that the money's being saved for the college education. So they have these accounts where there's pre-established portfolios. They can be time sensitive or age based, so that as the child is young, the account might be more aggressive. As they get closer to school, then the account becomes more conservative, because you wouldn't want to be taking a lot of risk. Let's say, 3 to 5 years before they might be using the money for education. Typically with these accounts, the returns are not guaranteed. However, funds can be used toward any accredited college, graduate program, even certified apprenticeships, things like technical schools. You can use part of it for a student loan repayment. So there are stipulations relevant to that. And you can also use it for education expenses anywhere from K through 12. And there are limitations on all of those aspects. Prepaid tuition plans, those are typically plans that are generated by the state that you might be going to school in. What you do is you prepay the tuition, or you buy credits today, and those credits will mature and be equal to what the credits are today in the future. The return is typically guaranteed in the form of tuition coverage. So it's not guaranteed in the form as far as return of your payments or return of a guaranteed interest rate. So it's limited to your state's own plan typically. And typically you may have to go to an in-state public school relevant to using those prepaid tuition plans, because these plans are typically governed by the federal government, and they're also governed by state as well. Okay, so with these 529 plans, you do get tax deferred growth, the potential for tax-free earnings if those funds are used for qualified education expenses. So if the withdrawals are not for qualified education expenses, they would be subject to income taxes and a penalty. You may have fees and expenses with each types of one of these plans. So you want to be aware of that, just to make sure that you understand the plan. How does it work? What are the possibilities? What are the pros and cons relevant to any investment that you may be looking at? But we're going to move into retirement. So looking at retirement, we try to emphasize for people to start as soon as possible. So starting now versus putting it off. Putting it off, you have to play catch up in the future, which can be pretty devastating. So relevant to, again, taking a simple example, this is an example of 3 people, one who began at the age of 20, one who began at the age of 35, and the third person beginning at the age of 45. So just with an annual savings rate of $3,000, and they were earning an average of 6% per year, we can see that the first person that began at age 20, they were actually able to accumulate roughly $680,000. Okay, so pretty substantial. The second person starting at age 35, again saving $3,000 per year, earning a rate of 6%. They were able to accumulate roughly $254,000. And then our last person that procrastinated, they waited till age 45. They were able to accumulate $120,000. So even though no matter where you're at in life, we're not trying to dissuade you from not saving at all. But again, you can see the power of that compounding relevant to all of your savings. Because if you think about it, the person starting at age 20, they were saving $3,000 per year. And they did that for a 45-year period. So from age 20 to age 65. So they actually only put in the account $135,000. So that $135,000, because of the compounding of all of those gains, ended up to be close to $680,000. So again, you can see the power of compounding and the power of time when you're investing. So let's say, for example, my goal is to reach an amount of $680,000 for retirement. So the person that started at age 35 or the person that started at age 45, they're not going to reach that goal unless they save more than $3,000 per year. So they could do a combination of 2 different things. They could either save more and also take more risk to try to reach that goal. But the likelihood of them even reaching the $680,000, might be substantially lower, but they could potentially play catch up. But again, they're going to kind of sacrifice to do that later on in life. So when we think of retirement, we typically like to ask people 3 different questions. What kind of retirement do you want? When do you want to retire? And how long is retirement going to last? So by talking about what kind of retirement you want, it's really just thinking about closing your eyes and envisioning what would you like to see in retirement. Do you want to maybe move to a warmer climate? Do you want to travel extensively? What kind of things do you want to do in retirement? And then looking at when do you want to retire? That would be, as far as the time frame. So if you remember, we talked about setting goals. We talked about time frame. So if you decide to retire earlier, you're going to have a shorter period of time to accumulate funds. And those funds are going to have to last longer as well. So looking at things like government benefits, such as Social Security. So currently, the youngest age you could receive Social Security benefits is at age 62, as well as health care benefits from the government, such as Medicare. The eligibility for that doesn't start until you reach the age of 65. So those are two pretty big important factors that people look at when they are planning their retirement. And then lastly, how long is retirement going to last? So average life expectancy typically continues increasing with each generation. So you might be looking at a retirement that might last 25 years or more. So again, you want to try to plan for that, because the last thing you want to do is obviously run out of money in retirement. So let's take a look at some of the different vehicles that you can use to save for retirement. So we talked about tax deferral and how that can help grow your money. We talked about taking advantage of a 401k for that tax deferral. So other advantages of using a 401k would be that your employer typically might be matching contributions. So let's say, for example, for every dollar that I put in there, they're going to match me 6%, dollar for dollar, up to 6% of my pay. So if I put 6% of my pay in, my company's going to put the same amount, 6% of my pay. So combined together, I would have actually 12% of my pay going into my retirement plan. So whatever your employer is matching you, you want to try to save up to the maximum of that, because otherwise you're leaving money on the table, which you could have otherwise gotten. So contributing to a traditional IRA or to a Roth IRA if you qualify. So again, some additional investments above and beyond what your 401k might be. So if you qualify for that, and the qualification is typically based upon your income levels. So there are certain guidelines around that you want to be aware of. And then again, remembering that 10% additional penalty for early withdrawals when you're using these tax deferred investments. So making sure that you're not going to incur any penalties relevant to trying to use those investments. So let's talk about estate planning. So we'll talk of a few terms here. One is called intestacy. We'll talk about wills and trusts, and we'll also talk about planning for incapacity. So each one of those is very important. So intestacy law, it can vary from state to state. So what intestacy means is that you've died without a will. And what happens here is that you have to follow the state guidelines or the state rules. So if I die without a will today, then the state of Pennsylvania is going to require me to pass my estate on, or pass on my property the way they outlined, not the way that I outlined or the way that I might want it. Okay. So you want to try to avoid that as much as possible. So this is a typical pattern of the distribution. It divides your property between your surviving spouse and your children. So even though you may have wanted all of your assets to go to your spouse, it's not going to happen that way, because the government, believes that your children are entitled to something, whereas your ex-spouse or your current spouse, if you're deceased, they could potentially change that, or they could not leave anything to your children in the future. So typically, one half might go to your spouse, and then the other half would go to your children. So again, pretty important to avoid that by creating a will. And it can also create a lot of problems for people that are trying to settle your estate in the future. So really, a will is the cornerstone of an estate plan. It's a document that's going to allow you to name an executor. It's going to direct how your property is going to be distributed. So not only naming an executor, you can also name a guardian if you have minor children. So who would take care of those children if something were to happen to you? You can name that in your will, because otherwise the state will come along and determine who will take care of your children. So again, something that you may not want to have happen. So it can also help to reduce taxes. It typically must be written, has to be signed by you, and it has to be witnessed. So it can be witnessed, it could be notarized, but it's pretty important. You may want to see a professional. You would definitely want to see an estate planning attorney, someone that's done this in the past. They're pretty proficient in doing estate planning. They know the current laws within that state that you might be in. Okay. So, it's not worth taking the risk of not planning properly and having something go awry. So planning for incapacity. So incapacity can strike at any time and it can strike anyone. So if you're in a bad car accident and you become incapacitated, how would that affect your situation? So again, failing to plan for that would mean that the court is going to appoint a guardian for you. Someone that's going to take care of your affairs. Someone's going to take care of your finances. So again, it increases the burden of the guardian. So even a court appointed guardian may have to go back to the court periodically to get that guardianship reinstated. They may have to go back for specific decisions that are made if they're large decisions. So various aspects like that. Your guardian's decisions might not be what you wanted. So unless the guardian that you pick and choose is the person that you know very well, and that they're going to keep your situation, they're going to keep your affairs consistent with what you're currently doing. That's pretty important aspect. So planning for incapacity typically means creating either healthcare directives for medical situations and also creating what's called a power of attorney. So a power of attorney comes into play when you're incapacitated. It gives that person the ability to manage your financial affairs, things like paying your bills, making sure your investments are properly managed, various aspects like that. So I want to thank you for taking the time to listen to our class on financial planning basics.